Audio check. Audio check. Test. Audio. Check. Testing the audio. Okay, checking the audio again, testing. See, we have a few people on YouTube and Facebook. If you wouldn't mind, if you're on YouTube or Facebook, either one, please just put a note in, make sure you can hear me. I would appreciate that. Just put a comment saying, hey, I can hear you. Maybe let me know where you're from. Hey, thanks, Denise, on Facebook. Appreciate that. Our YouTubers are always the bashful ones, it seems like. They take a little while to put a comment in. Welcome to everyone joining in here. Glad to have you. Good to see you. Although I can't see you so much, but you can see me. Great. Thank you, Brenda. So 2 Facebookers. Anybody on YouTube willing to throw something in the comment section? Let me know that I'm good for the audio on YouTube. I appreciate that. Okay. More on Facebook. Good. Facebook is good. All right. Thank you for all that. Appreciate you. Let me check a couple of things here. Let me make sure our YouTube feed is live. Looks like it is. Looks like we got people there. Hey, there we go. And Jill Moreland. So that's very interesting that the name is Jill Moreland. I can hear you in Massachusetts. Did you register for an account just to tell me that, Jill? If you did, I'm very honored. Thanks, Jill. Appreciate that. Yeah, it always seems like our Facebook folks get in quick, but then our YouTubers end up outnumbering you. So we'll see what happens. We will see what happens. Anyone here for a repeat visit where you've seen the workshop more than once? Or is everybody here for the first time? Okay. Good, mostly first timers. Okay. Yeah, every so often I hear of people attending more than once. Not sure if that's. I had someone tell me that sheepishly one time that they attended this workshop 3 times. So I don't know if they were feeling embarrassed, but they shouldn't. Social Security law is 3,600 pages, so if you can get it in one shot, you're better than most. More first timers? Okay, cool. I haven't even cracked my good jokes yet, and we already have somebody giving me the laughing emoji for this workshop. Hopefully they're laughing with me, not at me. Save the laughing emoji though. None of the good jokes have come out yet. This is just a build-up, little build-up. We do hope that you'll subscribe to our YouTube channel and follow our Facebook page. We love interacting with people. We do a daily podcast. We just started doing what we call Retirement 360, which takes a more in-depth look at retirement planning topics. And we know that you'll find that to be very helpful and interesting. Also, interestingly, today's topic, the inaugural topic, was about Social Security. So I encourage you to check that out. Easy way to find our additional content and podcasts is subscribing to our YouTube channel. If you do follow our Facebook page, you'll see all the links, but you'll have to click them, and it'll take you to YouTube. Or if you're a podcast person, you can go to your favorite podcasting destination and subscribe to our podcast, and we'll do it. You'll be able to download it. Sharon, how long is this going to last? Very long. No, I'm just kidding. I understand. It'll go just about an hour, Sharon. We'll start right at the top of the hour, about 7 minutes. We're about 7 minutes out from our start time. We'll get started right at the top of the hour, and it'll last about an hour. I encourage you, Sharon, to get a glass of wine. No reason to rush away. Have a good time. Enjoy things. I know that's what you all came here for, of course, was to have a glass of wine and relax and learn about Social Security. You're welcome, Sharon. Has anyone here ever called the Social Security office? That's what we talked about in our Retirement 360 episode today, was we talked about an experience, we've had many experiences helping our clients calling the Social Security office with them, but we also had one of our very own, Mr. Dave Harden. He's 65 and called the Social Security office about Medicare, and he had a very interesting experience, I have to say. Frank, all the time? You call Social Security all the time? I don't know what you're responding to, Frank, but I kind of like it, if that's what you're saying. I had a friend was texted me, had to let her know what I was doing dirty. I don't even know what to do with that, Karen, but I hope you ask a question later, because it could be fun. Yeah, okay. Yeah, you've called Social Security before, Judy? All right. So Sharon, yeah, it's interesting. You should check out our little meme. We have a little meme posted on Facebook. That's I think is kind of funny. You got to know the Minions thing, I think, to understand who the character is. But Social Security's gotten a little interesting lately. Okay, we're going to get started here in about 4 minutes. Get your cups of water, your teas, your coffees, whatever you need. But we will get rolling here in just a couple of minutes, so hang tight. I do encourage you to get a glass of water, cup of tea, whatever keeps you excited. Well, so far, I have to say, it's neck and neck. Our Facebookers are 30 and our YouTubers are 33. Yep, YouTube's overtaken you. All right, Facebook people, if you'd like to I like your comment, Frank. It's an experience getting programs we paid for. If you'd like to get your Facebook, if you'd like more people to be on Facebook than YouTube, you can make it a little competition if you like. Just, share the live stream, let people know. I'm sure all your, children and grandchildren, that's what they want to do tonight is learn about Social Security. So, share it out there. All right. What's the link to the group in Facebook? Yeah, if you just go on Facebook and search Einstein Social Security, that's our Facebook page. You'll find us there. Just search for Einstein Social Security. If you subscribe to our YouTube channel, you get more notifications about our podcasts and things there, which is nice. We're going to get started here in about 2 minutes. We got people joining in quickly, so we'll get started right on time. So hang tight. If you haven't yet gotten your cups of water or tea or whatever your beverage of choice is and you want to run and grab that, and go do it now. Run to the restroom, whatever you need to do. But we'll get rolling here right on time. YouTubers are really taking off here. Facebook's getting left in the dust. More people on YouTube. Just so you guys know, if there's ever an issue, during the workshop where there's some tech issues at all and you're having any kind of problems, just know that you can switch, right? You can go to YouTube, you can go to Facebook. In that text that we sent out or however you found our video here, what you want to do is you just go back to that link and you can switch over. So you go right back to the link that we text out to everybody, and when you go to that text, you can pick YouTube or Facebook at that time, and then just pick the other option, right? So if there's any tech problems at all, you can switch. Should just pick up right where it left off. We're going to be about an hour there, MMSH choices. About an hour. Good, I'm glad you have questions, Karen. We have a Q&A part of our time. Got about a minute till we get started. Hang tight. There's always replay, Sharon, so stays up for about a day. You can watch it on replay. So, yep, for about a day, though, okay? But feel free. We encourage you to do it. Watch it 5 or 6 times. I don't know if you need to do that, but you watch it as often as many times as you would like. Okay. All right, we're going to get rolling here. Need my clicker. All right, welcome everyone to another Einstein Retirement Workshop. This is our most popular presentation, our Social Security Filing Strategies Workshop. And I think I have learned over time that the reason why this is our most popular presentation is because A, everybody qualifies for a benefit for the most part, not entirely everyone, but most people do. And B, Social Security is maybe a little underserved. Most planning around Social Security is a little more simple than what it actually is. And so it causes people to make, usually it's not big mistakes, it's just little mistakes, but sometimes those little mistakes can compound over time and can cost you dollars either from a tax perspective or a benefits perspective that maybe is a little hidden. So we're glad you're here. We know you get a lot out of today's presentation. It's been something that we've been honored to continue to do for folks, even since the pandemic and the COVID-19 stuff. Past that now, even though things are opening up, we continue to do this and we continue to get great response and have lots of folks like yourself who want to attend and figure out what's going on with benefits. So we're honored that you're here. We're glad that you're here. Einstein Retirement Workshops is a national educational brand that is dedicated to educating retirees about their retirement options and strategies, things that are important to you. So Social Security obviously plays right into that. And again, it's one of our more popular presentations. As I mentioned, for some of you who were on right a little earlier, we do encourage you to subscribe to our YouTube channel and follow Facebook page because you'll get to see other content. We produce additional content. And so we encourage you to see future events. We always live stream everything, so you're always welcome to join live or watch it on replay. Okay, let's get going. Our agenda for today, and I'm wondering if my clicker is out of battery. Nope, just didn't click there. Okay, we will spend about an hour on the topic of Social Security. At the end of our presentation, we know that many of you are looking to get our Social Security filing workbook. This is something we absolutely want to get to you, and we'll talk about how you can get access to your free copy. And so we'll do that right at the end. Also at the end, we will go right into a Q&A portion of our time together where I will take your questions. Just simply put them in the comment section, whether you're on Facebook or YouTube. Doesn't matter. I can highlight your questions. We'll answer them right at the end of today's presentation. My name is Kyle McCauley. I'm one of the national presenters here at Einstein Retirement Workshops, but in addition to that, I'm also the managing partner of City Center Financial, which is a retirement planning firm. And I just highlight that for you in addition to my credentials of being a chartered retirement planning counselor and an accredited portfolio management advisor, because when I do this presentation, the focus and the thoughts that I'm having about Social Security are specifically dedicated and focused on what do these benefits mean to your retirement plan and how should you be thinking about them. And that is based on our experience in helping thousands of folks make really high quality retirement planning, coordinating Social Security into those retirement planning decisions. I'm also a National Social Security Advisor Certified Professional. Every member of our team is a National Social Security Advisor Certified Professional. Very important. Social Security's law is more than 3,600 pages. You cannot accidentally become an expert in Social Security. It is so very complex, and it is so important to have ongoing training and education to stay on top of Social Security topics and questions and how best to think about these things as it pertains to a multiplicity of individual circumstances. So just want you to know that everyone associated with our organization does have that specific credentialing, which is provided by the National Social Security Association. We are not employed by nor are we affiliated with the Social Security Administration. I would say that's a good thing because technically, although it's something that has been of an interesting experience from our view lately, technically Social Security isn't supposed to be providing you advice about your benefits. They can provide you education, which sometimes seems to appear as advice, oddly enough. But yes, we can actually provide you advice because of our registered investment advisory firm, City Center Advisors, which does allow us to provide advice to clients. Okay, why is Social Security such a hot topic? Why are all of you here? Well, every day, 10,000 baby boomers are turning 65. That's about 70,000 people per week, 280,000 people in a month, and 3.64 million people every year are turning ages where it's starting to make sense to file for things like Medicare, Social Security, other types of benefits. So that's a lot of people. And it brings up issues and concerns of things like, hey, this seems like a lot of people who were once paying into the system. What if they're now retiring and actually drawing money out? Is this going to last? Is this going to work? And I'm certain many of you have heard things like that. And so we'll talk a little bit about insolvency. It's a big deal. Currently today, 65% of middle-income Americans are deriving more than 50% of their retirement income from their Social Security benefits. And that's true even for those who've maybe done a good job of saving things like 401ks, accumulating a pension or other sorts of retirement savings. Reason for that, Social Security is still here. I know many of you were told, hey, don't count on Social Security, but it's still here. And in many cases, the benefits can be quite good. So not uncommon for married couples that we see to be getting $40,000, $50,000, $60,000, $70,000 and sometimes more in combined benefits. We also know that pensions are going away rapidly. I will tell you that it seems like every single year we're seeing fewer and fewer folks who are coordinating pensions with their Social Security benefits. We're seeing a lot more people who are having to do things like coordinating cash flows out of 401k plans and IRA accounts with their Social Security benefits, which is two different types of strategies going on there. So pensions going away, getting frozen, eliminated. Unfortunately, seeing pensions cut benefits even after folks started them makes and elevates the importance of those Social Security dollars. Presently today, 46% of Americans are passing away with less than $10,000 to their name. That statistic is there because what Social Security is, when you frame it into your retirement income plan, is longevity insurance, or you could say retirement income insurance. Now, why the word insurance? Well, insurance is not a bad thing. You insure a lot of important financial things in your life. Your house, your car, your health. What about your retirement? Yeah, sure, you actually do have some insurance around your retirement, and Social Security is a form of retirement income insurance because no matter how long you live, even if you're this person passing away with less than $10,000 to your name, you still have Social Security so long as you qualified for a benefit and you're still living. Those dollars will pay to you. Now, if you're a married couple age 65, planning for the possibility of living a really long time could be pretty important. Gentlemen, you would have a 50% chance of living to 92, and ladies, you have a 50% chance of living to 97. So those are your life expectancies. It's not uncommon for folks to live much longer than they were thinking they would. Why is that? Well, medical technology, there seems to be a lot of education about health and trying to make improvements there, and we see people all the time trying to do things to improve their health. And so people often are living much longer than expected. My grandfather's a great example of this. My granddaddy passed away last year at the age of 92, okay, not COVID, just old age. And he had 3 heart attacks and 4 bypass surgeries before the age of 75. I mean, if you'd asked him, hey, Granddaddy, you think you make it to 92? He was kind of a gentle, not a big talker, but he would have smiled, shook his head and said, I don't think so. But there he was, he still lived that long. So important when you're thinking about Social Security to remember that you might live much longer than maybe you expect to. And Social Security becomes a really nice source of income that's going to pay to you no matter how long you live. Currently the oldest living person, I don't know if you can beat her, Ms. Kane Tanaka. She's 118 years of age. She lives in Japan. And of the last 5 oldest living people, 4 of them are from Japan. So if you're thinking about doing some relocating, I might consider Japan. Our focus for today, we're going to talk about some basics about how your benefits work, how they're calculated. We'll talk about some strategies for those of you who are married, options for those of you who are divorced, options also for those of you who are widowed or are widowers, and If you fall asleep somewhere in the middle, please do wake up in time for taxes. I don't care if you're single, married, divorced, widowed, doesn't matter. If there is one single item that could change our thinking about how you file, where it says, yeah, you know, this looks pretty good, but I think this is the way we got to go instead, it's going to be this tax issue. Taxes is a very big deal, and it's often overlooked when it comes to Social Security planning. So I want to make sure we have enough time to cover that for you. Let's talk about some basics around how your benefits are calculated and how you earn a benefit. In order to qualify for a Social Security benefit, you need to have 40 credits. 40 credits works out to 10 years worth of work because you can earn up to 4 credits per year. By having $1,470 of earnings in a calendar quarter will get you 1 credit. So if you do that 4 times, you get 4 credits in a year. 40 credits qualifies you for a benefit. Once you've qualified for a benefit, the way your benefit is calculated is by using the highest 35 years of indexed earnings, no matter how I'm sorry, I just got confused by some comments I'm seeing in YouTube, but it looks like we're already good to go there. All right. Okay, so highest 35 years of indexed earnings. Okay, it's not the most consecutive 35 years. It's not the most recent 35 years. It's the highest 35 years no matter when they occurred, and it doesn't it's not based on the earnings that you had in those years. It's based on the earnings that you had in those years after they've been increased to cover inflation. For example, $20,000 earned in 1980 for a Social Security benefit perspective is worth more than $80,000 in today's dollars. The way you would know that, if you were to get our Social Security workbook that we'll talk about how to get at the end, you could see that on an indexing table in that workbook, you would take $20,000, if that's your number, on page 3 of your statement. You could put it in that workbook and you would see that you need to multiply it by 4 and change, making it worth more than $80,000 in today's dollars. So highest 35 years, but it's after those dollars have been indexed for inflation. Just because you're working today does not guarantee that you're increasing your benefit for the future. You have to replace the lower income year in the past in order for your work today to increase your benefit. Also, what happens if you don't have all 35 years? So you have 10 years at least, but you don't have 35. What if you have, say, 25 years? Well, they'll take the 25 years of work, index them for inflation, and then add 10 zeros when they calculate your benefit. So any additional work that you're doing today is replacing a 0 and should have a good size impact in terms of increasing your benefit for the future. There are some things that can reduce your Social Security benefit. The main one is having a government pension that is a non-covered pension. That provision is called the WEP Windfall Elimination Provision. What happens is, if you have the windfall elimination provision by having a non-covered pension, and you also have a Social Security benefit from other work that you did outside of that job where you earned the pension, when you claim Social Security and also the pension, you could experience a reduction factor to your Social Security dependent upon how many years of substantial earnings you have under the Social Security system. All the calculations for this are in your workbook, and so I encourage you to get it. I do not have them memorized, so I couldn't tell you exactly, but it's too complicated to really memorize. At least I haven't made the attempt. Okay, the government pension offset is the other provision. If you have a non-covered pension and you're thinking to file off a spousal Social Security, this one can reduce your benefits to 0. The WEP, the windfall elimination provision, cannot reduce Social Security to 0. You'll always get something, but the government pension offset can reduce it to 0. The scenario is you file for a pension and a spousal Social Security. 2/3 of your pension reduces the amount of Social Security, and if that's a negative number or 0, you get nothing. If it's some small amount, then you get the some small amount. You've paid a lot of money into Social Security. I think you know this, but if you don't, 6.2% of your pay has been going into the Social Security system over the last 10, 20, 30, 40, however many years you've been working. Your employer did the other half of that for a total of 12.4% of your pay. Also, on top of that, if you were self-employed, you got to do both. So you've put a lot of money in this system. I think if you could imagine an account somewhere with your name on it, now this is not how Social Security works, unfortunately, because wouldn't that be cool? But if you had an account somewhere with your name on it, with 12.4% of your pay in it, and you applied even a little bit of interest, that would be a lot of money. Now, unfortunately, the system today is pay as we go, meaning you don't have an account. Your tax dollars are going into the system to pay current recipients right now. Pay as we go. The system's broke. Okay, it's running on empty. So we're in the red, and we've been in the red since 2010. We don't fully run out till 2035. Okay, kind of makes me think of a friend of mine who always liked to run his gas tank down to almost nothing. I always asked him why. He said, I don't know. I just don't like stopping for gas. So you ask your politician, hey, why don't we fix this? I don't know. It's no fun to try and fix Social Security. So yeah, we're only fully funded through 2035. So in 2036, we're only funded roughly 75 cents on the dollar thereafter. The system will have to be fixed. It's been fixed many times before, so I wouldn't panic too much. And current federal law states that once you hit the age of 55, your benefits you can count on. So this is the changes to Social Security to fix it are going to affect your children and grandchildren, most likely not you. Okay, not guaranteed, but I'd give it a 98% chance that no one listening to this, unless you're younger than 55, is going to be affected by changes. The way the changes work, you kind of know intuitively. Okay, they'll increase the full retirement age. They'll increase the minimum filing age. They'll push up the maximum filing age. Okay, you know this. All of your parents had a full retirement age of 65. The youngest of you have a full retirement age of 67. There's a bunch of you who have a full retirement age of 66 and some number of months. And there's some of you who are old enough to have a full retirement age of 66. But all of you have an older full retirement age than your parents who are at 65. That is a reduction to the benefit because it pushes out the age that you can file to get your full retirement age amount. So they didn't like cut your check, they just said, hey, you got to work longer to get that full amount. So that's effectively a reduction, and they'll do some version of that to your children and grandchildren. Now, in terms of understanding your benefits and what different filing ages are and how they affect what you get, we're going to assume for just a minute that everyone here has a full retirement age of 66, just for ease of explanation. On the very front page of your Social Security statement, in the upper right corner, that big bold number is your estimated primary insurance amount. That primary insurance amount is your full retirement age benefit. If you file for that at your full retirement age, you receive 100% of that amount. So if that number says $2,000, you would get $2,000. You're allowed to file early. You can file as early as the age of 62. If you did that, you'd turn that $2,000 into $1,500 or 75%. The decreases happen on a monthly schedule, not annual. We often talk about it annually, but the reduction factor is actually a monthly reduction. Same thing for the delayed retirement credits. If you delay past your full retirement age, you can earn 8% per year in delayed retirement credits, or otherwise said, 0.8% per month for every month you delay, all the way up until age 70. And then at that point, you could earn 132% simple interest of your benefit. So $2,000 would turn into $2,640. There are three benefits that you have eligibility for potentially. The first is a retired worker's benefit. The second is a spousal benefit. And the third would be a widow or survivor benefit. All these different types of benefits have different provisions. In addition to spousal, we would also think of ex-spousal benefits. And in addition to widow or survivor benefits, we would think deceased spousal benefits. Okay, so all of those could be benefits that you may be entitled to. The last time Social Security law was changed was in October of 2015. Basically what they did was they took away all the fun stuff. No more filing, suspending, get a lump sum check, all of that kind of stuff is basically entirely gone. Except for one thing. If you were born before January 2nd of 1954, and you have not yet filed for a Social Security benefit, and you have access to a spousal or ex-spousal benefit, you can do a restricted application, and that restricted application will entitle you to file for your spousal or ex-spousal benefit without touching your own. But you must be born before January 2nd of 1954, and you can't have already filed for something. So that's a rapidly diminishing group. So for most of you, it doesn't apply. For those of you that it does, if I went through it too fast, just ask a question, we'll answer it. Okay. For everyone else, including that group, just a couple of things to remember about filing strategies. Number one, if you file for benefits and then you say, hey, wait a second, I don't need this money yet. What did I do that for? You may rescind your application one time so long as you're within the first 365 days. If you rescind your application, you tell Social Security, stop paying me. They'll say no problem, but you must pay back any benefits that you've received so far to reset your benefit as though you never filed, okay? But it's an option. You can do it one time. The second thing that you could do with Social Security is just simply suspend benefits. You're allowed to suspend benefits at any time for any reason. If you're older than 70, don't suspend benefits. There's nothing in it for you. If you're younger than 70, you could suspend benefits, and from the point of suspension until as late as age 70, any increases that you're entitled to, you can earn. So imagine a scenario where you've been working, you retire, and then you realize, retirement's so-so, not too fun, not as much fun as I thought. I should figure out what I want to do next time. I'm going to go back to work for a little while. Okay, so you go back to work, now you have Social Security, you don't really need it. You can suspend benefits until you retire for real, and then you can reclaim your benefits, and any increases that you're entitled to while you're suspending, you will receive. Let's talk about spousal benefits. In order to qualify for a spousal benefit, you need to have been married for at least 1 year. The spouse that you're filing from must have filed their benefit. If you have your own benefit, let's say my benefit's $1,200, my wife is $2,000. I am generally entitled to 1/2 of her primary insurance amount. If her full retirement age benefit, or PIA, is $2,000, half of that is $1,000. My $1,200 is greater than that. I say goodbye to the spousal. I'm just getting my own. I don't get some of mine and some of hers, none of that stuff, okay? It's up to 50% of your spouse's primary insurance amount, not their benefit amount. So if John is eligible for $2,000 a month at his full retirement age, Jane's eligible at her full retirement age to half of that, $1,000. But if Jane files early, she doesn't get $1,000, she gets $1,000 reduced. If John delays till 70, he gets $2,640. Jane still only gets $1,000. So spousal benefits reduce at a faster rate and don't earn any delayed retirement credits. So if I have my own benefit of $1,000 and I delay till 70, I can turn it to $1,320. But if the $1,000 is a spousal benefit, the most I can get is still $1,000, no delayed retirement credits. On the flip side, if I have my own benefit of $1,000 and I file at 62, I get $750. But if it's not my own benefit, it's a spousal, I don't get $750, I only get $700. So extra penalties for spouses to file early and no incentive to delay past full retirement age. For my married couples, when one of you passes away, only one benefit remains. It's always the higher of the two. So the only exception to this, well, let me say this first. If my wife has $2,000 and I have $1,000, I predecease her, I take my $1,000 with me, she keeps her $2,000. If she predeceases me, I say goodbye to my $1,000, I keep her $2,000. Only one benefit remains, it's always the higher of the two. If my wife had filed early, say at 62, she'd be getting $1,500. The 82.5% rule, though, says that I would get a bump up to $1,650 at her death because she's getting 75%. So there's a little bump up available if your spouse filed early. Okay, 2 most common mistakes that we see married couples making. Number 1, the higher wage earner files early and shortchanges the survivor's benefit. Remember, when you file for Social Security, longevity insurance. But if you're married, it's not just you, it's also you and your spouse. So what happens if one of you lives to 75, but the other of you lives to 95? Could be talking about 20 years with just one Social Security check, so we'd like that check to be as high as it can reasonably be. The higher wage earner is going to have the survivor benefit, and so oftentimes it's worthwhile to try and push that up a little bit or try to maximize it if possible to really maximize those survivor benefits. The second mistake that we see folks making is that both spouses delay past full retirement age. This just comes from our experience in helping thousands of folks. It almost never works out that both spouses should delay past full retirement age. Generally speaking, one of you should file early to some degree or another, and one of you should delay to some degree or another. Okay, let's talk about divorced spouse benefits. In order to qualify for a divorced spouse benefit, you need to have been married for 10 years in a row. Also to the same person, as it turns out. So, married 7 years, divorced, remarried, even to the same person, 5 years, divorced. 7 plus 5 does not equal 12. One of those two stints has to be at least 10 years. I know you did not come on here for marriage counseling, but if you need a reason to hang on, there you go. You may not be currently married. If you have a marriage that lasted more than 10 years, you divorced, you're thinking, I'd like to file a spousal benefit, but you are now remarried. Say goodbye to that divorced spouse benefit. It's just your own and the new spousal benefit that you should be thinking of. Same benefit amounts in terms of extra penalties for filing early and no increases for delaying apply to the divorced spouse benefits, as did also those spousal benefits. Last bullet point. This is the big difference between divorce benefits and spousal benefits. If you have been divorced for more than 2 years, you are independently entitled to file benefits off of your ex-spouse's work history, regardless of whether they've filed yet or not. Meaning, in the scenario I laid out earlier, if my wife wanted to delay till 70, she could take her 2000 and turn it to 2640. I also have to delay if I don't have my own work history because I have to wait for her to file in order to get that spousal benefit. However, if we've been divorced for more than 2 years, I could file based on her work history, whether she has filed or not. Okay, if you're born before January 2nd of 1954 and we're in a marriage that lasted more than 10 years and you've not yet filed for a benefit, the restricted application could be particularly advantageous to you. One goofy thing about Social Security for divorcees is that if you hit 62 and start with your own benefit and you have a younger spouse that's not 62 yet, a couple of years go by, they hit 62 and their spousal amount is more than yours, you could switch. And if you could conjure up another 10-year marriage like that and they hit 62 and theirs is more, you could switch again. As many times as you can conjure up that scenario, it is allowed. Okay. Common questions we hear from those who are divorced. I'm divorced. My ex is going to file off of me. Is their filing off of me going to affect me in some way? No, it is not. I'm divorced. My ex will file off of me. I'm remarried. My new spouse is going to file off of me. Will their benefits affect each other in some way? No, they will not. I'm divorced and I've managed to fit a few 10-year marriages into my lifetime, and I'm remarried and I'm going to die young. No, just kidding. Okay, so yes, okay, all these people could be filing off of your work history. The new spouse could file off of your work history. And yes, in fact, if you do predecease all of them, they can all get widow benefits. So it is allowed. Okay, I'm divorced. I'm going to file off of my ex. Are they going to know that I've done that? Not unless you tell them, okay? The only way that they would know is if you told them. Social Security doesn't notify them. It doesn't affect them. Okay, let's talk about widow benefits. Widow benefits are a very unique group. They are the only group who is eligible to file for Social Security at the age of 60. In order to file at 60, assuming they were widowed prior to reaching 60, they must remain unmarried until reaching the age of 60. Very first workshop I ever did, gal in the back raised her hand during the Q&A and said, "So if I understand this right, it sounds like I should delay the wedding." Yeah, well, it was kind of a big deal for her. So here's the situation. It was a June workshop. The wedding was coming up in September. Her birthday, 60th birthday, was not until March of the following year. If she remarried in September, she was still 59. She loses the ability to file at 60 in March of the following year. She can't file for anything at 60 because at that point, all she was entitled to is her own or her new spousal, so she had to wait 2 years if she remarried in September. So, what was the difference? Well, her widow benefit that she was planning on getting was about just under $2,000 a month, and the next best benefit that she would have to wait 2 years to get was just a little under $1,500 a month, and that was the new spousal benefit. So yeah, it was kind of a big deal for her to put the wedding off. Now, I think this is funny. I'm a religious person. You can decide for yourself. She did go to the priest and said, can we just do like the religious part of the ceremony and sign stuff later? And the priest said, no. I told her, there's got to be another priest. Somebody will do this for you. But she's very devout, and the wedding was delayed. I also didn't get invited. Okay. Although I should have. I saved her a lot of money, but whatever. Okay. You got to be married a minimum of 9 months in order for widow benefits to have been made available. Special exceptions can apply to this, though. So this provision here is just to prevent deathbed marriages. It's not there to hurt people. Only real-life example I've ever run into with this, gal was married later in life, husband was in the armed forces, he was shipped overseas, killed in action, they'd been married just less than 6 months. She thought the widow benefits were not available, understandably. However, it wasn't as though he had a terminal illness or some known reason why he would be passing, so we just submitted documentation and the benefits were reopened. Okay, another widow case study. John never elected and died at the age of 64. His benefit would have been $2,150 at his full retirement age. We never met John, but we met Jane. She attended one of our workshops trying to figure out what is this widow benefit stuff all about. She's 5 years younger than John. She's 59 when John died. She remained unmarried until reaching the age of 60. And so she was thinking, maybe I should file a widow. I don't know. But she does have her own work history. $1,192 a month is available to her beginning at the age of 62. One of the most common things that we would see Jane do is that she would just go file for widow benefits, right? Maybe she lost John's income, she could use a little extra, so she goes and files for widow benefits. She gets $1,537 a month. She receives that until she passes away at the age of 85. Total lifetime benefits, $461,000. Now, Jane will not receive a phone call. I know you're all amazed to hear this. At 70, excuse me, hi Jane, yes, this is Social Security calling. We'd just like you to know that there's more money available if you'd like to switch. Yes, Social Security will not make that phone call to Jane. She has to know that if she starts with widow today, she can switch to her own at the age of 70, and her own benefit, increase to full retirement age, delayed retirement credits to 70, is worth more than $2,000 a month if she switches. Over her lifetime, that's $100,000 more over her lifetime in total benefits. She also has another option. She could actually start with her own. Let's say she's working, she can't really retire yet because of the earnings test, or she doesn't want to retire yet, so she can't file because of the earnings test. So she starts with her own benefit, $1,197, collects that till 67, and then at the age of 67, she switches to widow benefits, also $77,000 more over her lifetime, simply for knowing her options. Look, maybe I'm preaching to the choir because you're here, But I'm always struck by these numbers, 400, 500, 500,000. Very common for us to see married couples where this number's over $1 million, sometimes over $2 million, sometimes edging up there 2.5 plus. Not uncommon at all, especially when you factor in inflation, cost of living increases. For many of us, this Social Security decision may be one of the single biggest financial decisions of your lifetime. Again, maybe I'm preaching to the choir because you're here. I'm glad you're here, but it is worth taking seriously and doing the planning to maximize what you get out of this system. It's a lot of money. You are allowed to file for Social Security and work at the same time. However, if you are younger than your full retirement age, you must deal with what is called the earnings test. The earnings test says that at your prior to your full retirement age, if you file for Social Security, we don't care, Social Security says, about the first $18,960 that you earn. This is earned income, W-2, 1099, self-employment. However, the minute you go above $18,960 in earned income, you have to pay back $1 for every 2 that you go above the limit in terms of your Social Security. Here's how this works. Imagine for a minute that you file for Social Security and your earned income for the year will be $58,960 and you're 62. Well, the first $18,960, Social Security doesn't care, so we chop that off. Takes us down to $40,000 above the limit. Social Security cares about $1 for every 2 above the limit, so we chop it in half. You're ineligible to receive $20,000 of Social Security. Imagine that the Social Security benefit you're filing for is a $2,000 a month benefit. $2,000 goes into $20,000 10 times, meaning you will not receive a benefit in January, February, March, April, May, June, July, August, September, October. Then you receive a $2,000 check in November and a $2,000 check in December. Some people mistakenly assume that going over the limit means that you will not receive anything, that you will receive a benefit. It'll just be a reduced amount and you'll receive it all year. No. They simply will not pay you anything until you have paid back what you are ineligible to receive. Okay? So just be aware of that. Now, what happens if I'm $2 over the limit? Yes, they totally nix the entire month of January. So it doesn't matter that you only owe $2. They still take the full $2,000 or whatever it is in January. Okay, so do be aware of that. Now, in the year that you turn your full retirement age, but before you turn your full retirement age, the earnings test goes up. This year it's $50,520, and it's $1 for every 3 above the limit. This rarely affects anyone unless you're a very high income earner, and then you may need to pay attention to it. Okay, let's talk about taxes. What is on the screen here is publication 915. This is produced by the IRS every single year to help you determine how much tax you will owe on your Social Security benefits. Wait, I owe taxes on Social Security? Yeah, that's right, you do. Well, how does that work? It must be pretty easy. They wouldn't complicate it for us folks who are getting up in age and just want to enjoy our retirement and have a simple life. No, it only takes 33 pages for them to explain exactly how you will pay taxes on Social Security. I'm sorry. I shouldn't laugh about it, but it's just such a joke. Okay, there are helpful things. Maybe this is a little tongue-in-cheek, but yeah, technically this is helpful. This is the worksheet. Okay, it's page 15 of the report. And it will detail out for you the 19-step process that you must go through to determine how much tax you will be paying on your Social Security benefits. It actually doesn't tell you how much tax you'll be paying, it just tells you how much of your Social Security will be taxed. So that's another fun part. Okay, we are not going to detail out the 19 steps. I'm not going to go line by line and with sophisticated calculations of exactly how this works. What I am going to do is I'm going to highlight some principles that I think will be helpful to you when you're thinking about how taxes will play on your Social Security. Social Security is probably more of a tax planning decision than a longevity decision, because you can at least control a little bit, as much as you're capable, your taxes. Except for taking care of your health and a little good luck and maybe a lot of prayer, you don't have much control over how long you live. So maybe thinking about Social Security as a tax planning decision is a little better go. Certainly a retirement planning decision. Okay, 3 things go into line 1 of this worksheet, which is where you would put your provisional income. Line 1 of your worksheet is provisional income, which is 3 items, all of your income, adjusted gross income, earned income, annuity income, pension income, investment income, capital gains long and short, interest income, dividend income, all the sources of income that you have, rental income, everything, K1s, doesn't matter. Plus non-taxable interest, municipal bond interest income. Plus 50% of the Social Security benefits that you're receiving. Those 3 things together are your provisional income. If you are single and your provisional income number is more than $25,000, you start paying taxes on Social Security. If you're married and your provisional income number goes above $32,000, you start paying taxes on Social Security. Singles, if you hit $34,000, you could be paying tax on up to 85% of your benefits. Marrieds, at $44,000, you could be paying tax on up to 85% of your benefits. The question is, how much tax exactly? This is where it gets a little complicated. So imagine for a minute that you're retired, maybe some of you are, but imagine you're retired, you're collecting Social Security, you have some investment income or withdrawals from 401s or whatever, okay? You got your income. You're cruising along just fine through retirement. Everything's going great. You've been enjoying retirement, but, you know, this year you'd like to check off a bucket list item, spend a little extra money on a nice trip. And so what do? You start budgeting. Figure it out. Well, you are looking up things. Maybe you're planning with a spouse or a friend or a loved one, and you say, hey, let's go on a trip together. They say, wonderful. You say, okay, I'd like to go here. They say, that sounds great. You do the budget. You start putting stuff on the credit card. You rack up a credit card bill of $15,000. Nice trip. Yeah, you'll have a good time. It'll be fun. So you are the type of person, you pay off your credit card every month. You're not going to let that hang around. So you survey your accounts. Where am I going to pull this $15,000 from? Where am I going to get this money? And you look at all your various accounts and you come to your 401k and you say, hey, wow, that's grown. That's nice. It's got a sizable chunk of money in it. What did I save all this money for? I saved it for me. So I'll pull it from there. So you call up your 401k and you say, I'd like to pull $15,000, please. They say, no problem. Then they ask you a very important question. How much tax would you like to have withheld from that distribution? Oh, yeah, good question. Let me figure it out. Maybe you're feeling especially prudent or diligent that day, so you go and you look at a tax return. You see, oh, I'm in the 12% tax bracket. Get back on the phone. I'd like to withhold 12%, please. No problem. They send you your funds. You go on your trip, and then you get into next year. It's March. You're punching stuff in to TurboTax, and TurboTax is broken. What's going on? It says I owe money. I never owe money. I always withhold enough. You get on the chat. You start chatting with the TurboTax people. You get on the 800 number, whatever you need to do, because something's wrong. Unfortunately, Nothing is wrong. Here's what happened. When you took that $15,000 distribution from the 401k, what you did not account for is that you were above these limits. And so when you took that distribution, you simultaneously added taxes to your Social Security. You didn't get more money from Social Security, you just added taxes to Social Security. And 15,000 taxed at 12 plus 15,000 taxed at 12, you should have withheld on that distribution 24%. Ooh, ouch. That's no good. That's not fun. Nobody likes paying in tax season. You like to get a little refund, even if it's just a couple $100. That's always nice, but unfortunately, not this time. Well, you're not going to make that mistake again. And in fact, you always wanted to, make sure that you had enough down the road. You'll budget out next time, no problem. We're not going to get hit with this big tax thing again. Let's go through retirement. Let's enjoy life, but let's build up these accounts. Let's make sure we have enough money for the rest of our lives. All that stuff, all the good, prudent stuff that you did. You put the money in, you got your matches, you took some money back from the IRS. Great. But unfortunately, if you don't spend down these accounts over time, they continue to grow, most likely. And if they grow to a very sizable sum, there is a day of reckoning that causes this to become a very big deal. It is when you turn the age of your required minimum distribution. Presently, that is when you turn the age of 72. At the age of 72, if you have dollars in a 401k, 403b, 457, TIAA, TSP, IRA, SEP IRA, simple IRA. Doesn't matter what the type of account is. If you got a tax deduction going in, it's time you have to pull dollars out. It's called a required minimum distribution. The more money you have in these types of accounts, the higher the distribution requirement will be. And then you go above these limits. And then you add additional taxes to Social Security. And if you're not careful, that distribution will be large enough that, whoops, we're not in the 12% tax bracket anymore. Plus, maybe we're far enough down the line that's not 12. Anyway, it's 15. And the next one up is not 22, it's 25. And now it's 25, and 25 is 50%. Don't make these kinds of tax mistakes. Very important to do pre-planning so that you can help avoid those kinds of scenarios and to make sure that as you're planning and making this Social Security filing decision, you actually take advantage of the fact that Social Security is actually a tax advantage so long as you manage the other sources of income that you have and how they're coming to you. If you don't, you can watch the tax advantage totally disappear, or at least mostly disappear. So try to do some things to manage this scenario, these income dollars, so that you can minimize the long-term tax exposure when it comes to your benefits. Let's talk for a minute about a scenario that kind of highlights how this works. The clients are age 64 and 62. They're ready to retire. They're going to retire and have $34,000 in Social Security coming in. They've saved up $752,000 in their 401k and IRA accounts. They would like to spend $70,000 per year, increasing at a rate of 3% per year to keep up with inflation. They'll live to 86 and 89 respectively. If this couple uses an early Social Security filing strategy, they cover about half of their income need from those Social Security dollars. The rest of their income, the orange lines, comes out of their 401ks. The red line is what they need to hit to reach their income target. The amount of orange above the red is the amount they're paying in taxes. You'll notice that double taxation process I described is affecting this client because the amount of the orange line above the red is not increasing linearly over time, it's increasing exponentially. That's because as they increase their income to keep up with inflation, it's causing more dollars of ordinary income, more dollars of Social Security to become taxable, and those taxes go up. Unfortunately, they put so much pressure on their investments, they run out of money 14 years too soon. The only difference between this slide and the next slide is a change in the Social Security filing strategy. See, some of you are hearing this example and you're saying, well, $752,000, I mean, I don't have that much. I mean, does this really apply to me? Look, this couple of 752 has a running out of money problem. Social Security is going to help solve that. So stick with me. There's some of you who are saying, well, that's about right. Okay, so obviously this is great. Okay, you're getting a lot out of this. But there's some of you who are saying, only 752,000? They got to keep working. I knew you were going to say they run out of money, Kyle. Yeah. I knew that was coming. But look, they only have 752 and they have a tax problem. So if you're saying, gosh, that doesn't seem like enough, then maybe you have a tax problem. We're going to show how Social Security can help solve that right on this next slide. Here's what happens. If they fund their retirement entirely from their 401k and IRA accounts for those early years, yes, they pay a little bit more in taxes in those early years. But look at this. Once they trigger those Social Security benefits on a delayed schedule, an optimized schedule, they start getting some of the tax advantages from Social Security. There's a little bit of orange above the red, but not much. It is not totally uncommon for us to do pre-planning for folks and to get them into a position where sometimes they pay very little, maybe even no taxes by the time they trigger those Social Security benefits. We'll see if we can pull it off, right? It's a good deal. They take all the pressure off their portfolio, and you see here, their portfolio lasts for the rest of their life. If we compare the taxes side by side, optimizing Social Security causes them to pay a little bit more in taxes for those early years. But look at all these excess taxes being paid simply for filing Social Security early. I can tell you this too. Many folks that we do pre-planning for have additional tax planning opportunities with Roth conversions, restructuring investment accounts to generate different types of income that can get these taxes on the blue lines down to nothing. Now, eventually, filing Social Security early does do some nice tax saving in the year 2035, but they're broke, so it's not a good deal. If this couple optimizes Social Security, they get $186,000 more out of their benefits. Their portfolio lasts 14 more years, and they pay $35,000 less in taxes, even though they're not paying any taxes for 14 years when they file early. It's just they got hammered in taxes for so many years, and then they just ran out of money. But they still save by optimizing Social Security. Okay. Few quick things about your Social Security statement. Your Social Security statement, okay, it's that 4-page report or maybe 5 pages, 3 pages of your actual numbers. Page 1, big bold number. Next page, what do you get at 62, full retirement age and 70. Next page, your earnings history. There's no cost of living adjustments applied to that. It's just a snapshot of today. It does assume that you're working till 62, retire, file immediately, or working till full retirement age, retire, file immediately, or working till 70, retire, file immediately. Doesn't take into account what if I say retire at 65 but don't take my Social Security till 70 or full retirement age. Could just be a little off if you have some variance there. It is your work history only, no spousal coordination, no divorced benefit coordination, no widow benefit coordination, just your work history, and then certainly no advice. So look, after hearing our presentation today, you may or may not feel that you could use some additional help with your Social Security filing decision. I mean, I don't know how you feel about it, but can you even imagine trying to make a retirement planning decision or even having a retirement plan without coordinating Social Security and factoring in taxes and looking at the layers of complexity and variance for your individual circumstance and see how it all works out specifically for you? Can you imagine trying to do this kind of planning without incorporating these kind of details? Unfortunately, we see people trying to do it all the time. We really encourage you not to be one of them. Take this decision seriously. Make sure, if you're not going to get the analysis from us, get an analysis from somebody who's talking about and paying attention to the level of detailed planning that's really required to make a good decision about Social Security, how it figures into your overall retirement income, your retirement plans, making sure you don't run out of money over the course of your life, and also minimizing taxes. I mean, I do talk to some people who don't mind paying a lot of taxes, but my general opinion is you've probably paid enough. Maybe we could do some things to take a little burden off, right? Especially in these golden years. Why pay too much in taxes during the golden years? I mean, I get it maybe while you're working and young, fine. But these are the golden years. Let's do some things to increase your scenario, to make things better, to put more dollars in your pocket so that you can enjoy things and enjoy your retirement. This analysis that we're going to offer to you is going to be no cost. Okay? We're not going to charge you for the analysis. It will be free to you. The analysis is free because, well, let me tell you like this. I went to Costco the other day. They're still not offering the favorite thing at Costco, the only thing that redeems Costco on the weekends, which is the samples. Costco offers samples on the weekends, or at least they used to. Still not doing it yet, at least not in my area. Maybe some of you have that. My favorite sample at Costco was always the grass-fed beef bratwurst. Love that thing, very delicious. Got me buying them, and we enjoy them quite a bit in my family in the summertime. Grill them up, yummy. Okay, if you're getting hungry, please just hang on for just a minute. Okay, so why does Costco do samples, or why did they? Well, it's not rocket science. They want you to try it and say, hey, that's pretty good. I think I'll pick that up. I'll grab it. I'll make a purchase. We view this analysis in a similar light. It's a good sample of the work and the value that we provide to our clients. We feel confident that if you get this analysis from us and you see the value that we provide to our clients, that we will have a good opportunity to earn the right or the privilege, or maybe I should say the honor, of being able to serve you with other retirement planning or investing needs that you may have. The analysis is no cost. If I could say it, I hope you forgive me for being so bold, but it's a tremendously good analysis. It's going to be the best analysis about this you've ever seen. Part of the reason for that is that it's going to have very specific and individualized strategies for you. We'll be able to easily compare strategies side by side and show you exactly the difference in how you file. We'll show you break-evens. But the biggest difference, the thing that separates our analysis from any other analysis that you will get out in the world of Social Security analyses, is that we dig in deep into taxes. I built an entire software tool that wasn't a software tool, but then we paid some developers to turn this into a software tool that allowed us to do specific, detailed planning. It's called our Retirement Defender software that will look at year by year, line by line, exactly how your taxes are expected to come in and what kind of planning options are going to optimize this for you and make sure that we give you an enhanced analysis that allows you to see, if I file this way, I pay this much in taxes. If I file this way, I pay this much in taxes. If I file this way with that and optimize my taxes, and I do some additional tax planning like a Roth conversion like this couple's doing here, yes, holy smokes, I can get to where I never again pay the full 85% on my Social Security. I can drop my tax bracket down into the 12%. This is a couple that always was paying 22. With some planning, got them down to 12. You know, your specific circumstance will modify things, but it's such a big deal. And we are very excited. We hope that you take advantage of this from us. We'll also compare and let you know, does it work? Was it successful? Did we get more out of our portfolio? Did we increase our tax-free dollars by doing these Roth conversions and optimizing your Social Security? We'll show you side by side. You'll see it in your numbers. This analysis is made available to you because of wonderful technology in this day and age. We've gotten tremendously good feedback from now hundreds of folks who have interacted with us over a video conference session for us to deliver this analysis to them. And we're confident that you're going to have a great experience with that as well. I mentioned earlier that all of our advisors, anyone that you would interact with to get this analysis, if you feel that you could benefit from it, are going to be National Social Security Advisor certified. What that means is that they have been specifically credentialed with not only that initial education, but ongoing education about Social Security. And, doubly, they just help a lot of people with it. And so you're going to be working with someone that's seen a lot of people, seen a lot of scenarios and examples, and will be able to help you think through this. Okay, that analysis will be conducted over a video conference. It doesn't matter what state you're in. We're able to provide this analysis regardless of where you are located. We've done it for people in Hawaii. We've done it for people in Alaska. We're in Michigan. We've done it for people in our backyard. We've done it for Texas and California and Florida and all over the place, all over the country. We've done these workshops and help people get the analysis. So don't worry about that part. We can get it to you no matter where you are, okay? Couple of quick things by way of disclosure, because we are a fiduciary firm and I need to be very transparent with you about a few items. Number one, my firm is City Center Financial. City Center Financial owns and operates now the Einstein Retirement Workshops brand. At one time, we were two separate entities, but we acquired now, a little more than 2 years ago, the Einstein Retirement Workshops brand. We do own and operate that brand. All of the advisors that you interact with will have been personally trained by me. Hope you think that's a good thing. And they will be ready to assist you with these big decisions coming up. In addition to that, as a fiduciary firm, we're required to act in our client's best interest. If we get to the point where it looks like, hey, maybe you're interested in hiring us for additional planning services or additional investing and retirement planning or investing services, those discussions, we'll be very transparent with you about what the fees and costs will be. The primary way that folks hire us is through investment management fees. We manage many retirement accounts, and so we would be honored to do that. I think we manage now a little more than 1,400 client accounts as a firm, and so if that works out, we'd be honored to help serve you in that way. We'll disclose all fees and costs to you. I can tell you this, typical advisory fee for our firm is 0.95%, although your fee could be lower if we're not doing advanced strategies, we're doing more simplified strategies, or you have larger accounts, or we're doing, say, more safe bond investments versus tactical equity strategies using algorithmic modeling, okay? But the point is that we'll be very transparent, whatever makes sense for you and whatever you want to have us use on your behalf, we'll talk to you about those fees very transparently, okay? So that's that part. Okay, we want to get you the workbook. I'm going to start taking questions in just a minute, so please start putting your questions in, but go to sendworkbook.com to get your workbook. We will make sure to get you a copy of that workbook. We know that many of you would like to receive that, and we're honored and happy to get that to you. So please, you'll go to sendworkbook.com to request the workbook. If you would like to request the analysis, you're going to go to the same website. It's the same form. When you're filling out the form to get the workbook, it will ask you, would you like to take advantage of your complimentary or free Social Security analysis? And we would love for you to take advantage of that, and we would be happy to interact with you in that way. Just simply say yes to that, and it'll take you to the next step. To enhance the analysis, you need to say that you need to coordinate with other assets and or need to pay attention to tax planning. And so if you say yes to those two items, you can take advantage of that enhanced tax analysis portion. And if you're gearing up for retirement and you want to make sure that you're ready to go from a retirement planning perspective, we do have our proprietary retirement planning process. It's called the Retirement Defender Planning Process. And that process will allow you to take advantage of, if you're requesting the analysis, you can say also, please, I'd like to receive the Retirement Defender Screening Report. That will help us analyze for you the 7 critical areas for your retirement planning and just help make sure, hey, are you ready to go? Are you ready for retirement? Whether you're retiring in 2 years, 5 years, 10 years, are you on schedule? Are you in a good spot to hit your goals? Okay, so that's what that report will do. That also is at no cost, and we're honored for you to take advantage of it. Okay, I think I've covered everything there. Sendworkbook.com, you can go to it at any time. Subscribe to our YouTube channel, follow our Facebook page. I'll start answering questions right now. Okay. Joan M. says, is that an 8% per year increase? Yes, 8% simple interest. Vani says, I understand why people attend multiple times. It's complicated. Yeah, it is complicated, Vani. I do understand that. One of the biggest things I would say, you're welcome to attend as many times as you like, but getting that individualized analysis specifically about your situation is really going to be the biggest benefit to you. Cheryl Hare says, if you are on, oh, what's happening here? I can't highlight Cheryl's question. Let's see. For some reason I can't highlight Facebook at the moment. Maybe we can fix that in a second. If you're on disability, Cheryl says, when do you switch to regular Social Security? When you reach your full retirement age. Catherine says, I missed the first 40 minutes. Will there be a replay? Yeah, you can rewind it right now. Yeah, just rewind the video, whether you're on YouTube. I think Facebook can do this. I know for sure on YouTube you can just rewind the video and watch it from the start. Judy says yes. Oh, thanks, Judy. Yep, Judy's, I talked about this earlier. Okay, great. Charles says, I lost internet at the most important part. No, he says at the end of taxes. Yeah, so Charles, you can rewind the video and go through that part again, okay? Yep, go to sendworkbook.com. Denise says, if we do have a retirement, should we still do the free analysis? I don't know what you mean by have a retirement. I mean, that would be a great reason to get the analysis, is because you have some retirement plans and that sort of thing. So yeah, definitely, Cheryl or Denise. Karen says, if you don't need to pay tax, do you have to file? File for taxes? Technically, no. Okay, sendworkbook.com. Oh, Denise is saying, if we do not have a retirement, should we still do the free analysis? Well, like you're not going to retire? I guess I'm not sure, Denise. Look, if you think you're going to get some benefit from the analysis, take advantage of it. Okay? I mean, let me just say it like that, okay? Don't worry about us. We'll be okay. All right, Linda says, what if you are separated and not divorced? How does that work? Not widowed or not divorced. Linda, you're going to file like you're married. Yeah. Is it a legal separation? You know, I don't know why, but for some reason I can't pull to mind if a legal separation changes things. Okay, you're welcome, Karen. Vani is asking, if you have to draw disability before full retirement age, can you reset the amount that you receive at full retirement age? No, Vani. No, it's just, you just switch over. They send you a letter saying, hey, you're on your retirement benefit now. That's all. Okay, I'm going to check something real quick about legal separation and social. Security. Yeah, okay. So legal separation still entitles you to a spousal benefit. It is not considered divorced. Okay, so you just deal with it like it's a regular spousal. Linda. I'm not sure I'm following exactly, Linda. Okay, again, you can go to our sendworkbook.com, request the workbook, sign up for the analysis. We'd love to get you the Retirement Defender Screening Report as well as the Enhanced Tax Analysis as a part of this Social Security analysis. Love to make sure that we get all that to you and interact with you in that way. Also, subscribe to our YouTube channel, follow our Facebook page. I don't know if you're saying I was choppy, Linda. I'm sorry. Maybe if you want to try to condense it, if I haven't answered your question yet, maybe try to condense it down a little bit, and hopefully I can answer the question for you. I'm not quite sure exactly what you're going for. Okay, all right, Linda. All right, I'm sure that our staff can absolutely help you. No problem. Oops. Just knocked off my mic there. Sorry about that. Okay, other questions? Thanks, Robert. Appreciate the compliment. If you found it to be especially helpful, recommend us to your friends, relatives, family. I guess that's the same thing, family and relatives. But we'd love to do that. Also appreciate reviews that you leave. It helps people know that you got some benefit from this workshop and that you found it helpful. It's certainly helpful to them to see that. Kathleen Burke says, does the amount that you can make go up yearly that you would have to pay $1 for every two? Yes, generally yes, Kathleen. So $18,960 is the amount this year. Last year, I've already lost track of it, but it was 18,000 something. The year before that was 17,000 something. So yes, it typically goes up. Rosetta asks, do you still add to your Social Security when you work and get Social Security benefits? Yes, so long as you're younger than the age of 70. Good, Denise, thank you. Appreciate that. Michelle Miller says, my Social Security income is $9,600 a year. What would be your recommendation for me, basically? Well, I don't know if you have access to any kind of widow benefits or ex-spousal benefits or anything like that, but that would certainly be of consideration. You'd want to take advantage of anything that's available to you there. Great, thanks, Carme. Appreciate that. Okay, Michelle, you're single. Okay. Gosh, I wish I had something that I could give you an idea about. I can't necessarily think of anything at the moment, Michelle. I'm sorry. Robert Straub says, last week you indicated that your fees average about 0.7. Today you said 0.95. Why the difference? Welcome back, Robert. Yeah, so again, that's why I said a typical fee. I just said it differently, but it's the same information. A typical fee, 0.95%. They can range average across all of our clients. because of a client size, the complexity of the investments. The average across all our clients is about 0.7. That's correct. So I just said it a little differently, Robert, but it's the same information. Yeah, nothing's changed. We just boosted up our fees. Inflation's coming, Robert. No, just kidding. That would be the logical response, but no, it's just I just described it a little differently, but it's exactly the same. Thanks for the great presentation. Good, thank you. Thanks for that. Thank you, Betty. Rosetta, thank you. Appreciate that. Glad it was helpful. Again, don't forget to go to sendworkbook.com and request your workbook. If we see you in the analysis process, we're excited for that. We're honored for that. And so we'd be happy to engage with you that way. We also encourage you to subscribe to our YouTube channel, follow our Facebook page. You'll see additional content and things from us that we hope you find very helpful and informative. And I would say that if I have a little mini mission in the back of my mind, it's to be the most credible source of financial news for retirees. So hopefully we can accomplish that. Also, leave a review. I thank you for all the feedback. Really appreciate that. But do leave us a review. Let people know that you found this to be helpful. Robert's saying, do you still offer the taxes in retirement webinar? Yes, we do. We do offer it on demand right now. We kind of shifted strategies a little bit there. It's something that we have found has been a good second workshop. So once people have seen the Social Security, they really like the deeper dive of the taxes workshop. So generally, we make that available once we've engaged with you in this process. We make sure that you get a link to be able to watch that workshop. But it's more of an on-demand webinar now. We will probably do it live a few times a year, but it's also something that kind of is cyclical in its energy. Social Security is pretty much people want to know about it all the time. Taxes kind of ebbs and flows. It gets pretty exciting. We get a lot of interest towards the end of a year. We get a lot of interest in the beginning of the year around tax season. And then kind of through these middle months, people are not as engaged. Carol Will says, great information. Thank you. Appreciate that, Carol. Good. I'm glad you're getting the analysis. I know you'll get a lot out of that. Joe P says, if full retirement age, do you still get taxed on additional income, or are you taxed until 70 anyway? Yeah, you're taxed forever unless you happen to have low enough income that you're not taxed. You always have to deal with taxes, Joe P. Sorry. No problem, Robert. Thank you. Thank you for the questions. Glad to have you again. Kathleen says, thank you. Okay, good. Michelle Miller, no additional benefits for me. No, I can't think of anything in particular, Michelle. Obviously, I assume you're eligible for Medicaid. That's a nice little benefit. Probably some benefits maybe with food support through your state, depending on the state that you're in. And, I don't know everything about your situation, but if you happen to own your home, I don't know. But if you do, potentially you could or might want to consider potential like a reverse mortgage or something like that to get some additional income. So you have some options. Great, Roberta. Thank you. Appreciate that. Thanks for the feedback. Okay, again, sendworkbook.com. Make sure we get you that workbook. We'd love to interact with you for the analysis if that's going to be helpful. And with that, we'll wrap up for today. Subscribe to our YouTube channel, follow our Facebook page. We'd love to see you at future events, podcasts. We do everything live, or at least try to, and so we hope to see you again in the future. And with that, we wish all of you a good night, and we'll see you next time.